Right now, tech giants are playing a high-stakes poker game with the global economy, and almost everyone is staring at the wrong cards. Meta is bluffing, traditional software is folding, and the smart money is quietly preparing for a massive shift in how wealth is generated. Hello, this is Warm Insight. Today, we're going to talk about the tech sector's new playbook, the shift from traditional software to artificial intelligence infrastructure, and the real hunt for revenue. Leaving a like and subscribing is a huge help to us. Let us step back and look at the grand casino of the stock market. Everyone is showing their artificial intelligence cards, hoping to impress the crowd. But under the surface, the foundational structures of the digital world are cracking. Consider Salesforce. They recently gave incredibly light guidance that sent shockwaves through Wall Street. Why did a titan of the industry stumble? Because the fear of artificial intelligence. Disruption is finally hitting traditional software as a service companies. To truly understand the magnitude of this disruption, we have to look back at the late 1990s and the explosion of the dot-com boom. During that era, the fundamental promise was that the internet would change the entire architecture of global business. That promise was absolutely correct. The internet did change everything, but the timeline, the mechanics, and the ultimate winners were completely misunderstood by the retail herd. You had companies with absolutely zero revenue spending, tens of millions of dollars on Super Bowl commercials. The herd blindly threw capital at anything with a .com attached to its name. But let us look at the infrastructure side of that exact same era. In the late 90s, telecommunications companies spent billions of dollars laying thousands of miles of physical fiber, optic cables across the ocean floor. They built the literal highways of the internet. Companies like Cisco Systems provided the routers and the hardware required to make those highways function. For a brief shining moment, Cisco became the most valuable company on the planet. But when the speculative bubble violently popped in the year 2000, the market ruthlessly separated the real infrastructure, builders from the speculative garbage. The companies that survived were the ones providing indispensable utility. We are watching the exact same dynamic play out today. Traditional software companies rely on a very specific business model. They sell subscriptions based on the number of human users sitting at a desk. If you have 10,000 employees, you buy 10,000 software licenses. But what happens when generative artificial intelligence allows one single worker to do the job of 5 people? Suddenly, a corporation only needs 2,000 human workers, which means they only buy 2,000 software licenses. The old revenue model collapses. The market is finally waking up to the terrifying reality that artificial intelligence is not merely a cool feature. To add to existing products, it is a fundamental weapon that destroys the old software business model. Meanwhile, Meta is playing an entirely different game. They are quietly exploring cloud computing services. You might ask why a social media empire wants to sell cloud computing. To grasp this pivot, we need to examine the origin story of Amazon Web Services. Back in the early 2000s, Amazon was just an e-commerce platform. They had to build massive, incredibly expensive internal server farms just to prevent their website from crashing during the holiday shopping season, in November and December. For the other 10 months of the year, those multi-million-dollar servers sat completely idle in dark rooms, wasting electricity and depreciating in value. Then, a brilliant operational shift occurred. Amazon realized they could rent out that idle computing power to other startup companies. That simple idea birthed Amazon Web Services, which transformed Amazon from a low-margin retailer into a high-margin technology monopoly. Meta is currently sitting on mountains of highly advanced computing power. They bought thousands of incredibly expensive graphical processing units to train their proprietary language models. Now, they are realizing they can monetize this vast excess capacity, just like Amazon did 2 decades ago. This is the real revenue hunt. The smart institutional money is not looking for a startup with a flashy artificial intelligence logo. They are looking for massive legacy companies that are fundamentally rewiring their business models to turn dead capital expenditures into recurring revenue streams. Let us shift our focus to the silent productivity revolution happening right now. In the private markets, there is a payroll and employment infrastructure platform called Remote. They recently surpassed $300 million in annual recurring revenue. They also just achieved cash flow positivity. But the most staggering part of their financial statement is not the top-line revenue itself. It is exactly how they achieved that growth. Remote increased their revenue per employee by a massive 50% without hiring a single new person. In the last month alone, artificial intelligence wrote 85% of their internal software code. To fully comprehend the sheer scale of this economic shift, we must travel back to the Industrial Revolution in 18th century Britain. We have to look at the textile industry. Before the invention of the power loom, creating fabric was a painfully slow, labor-intensive process. Highly skilled artisans worked by hand, and a single weaver could only produce a few yards of cloth each day. The entire global economy was strictly bottlenecked by the physical limitations of human muscles. But then Edmund Cartwright introduced the mechanized power loom. Almost overnight, one single worker managing a machine could produce the output of 50 manual weavers. This invention completely shattered the linear relationship between human labor and factory production. The artisans who refused to adapt were left unemployed and destitute. The Luddite movement actually formed to smash these machines out of pure desperation. But the factory owners who deployed this new mechanical leverage saw their profit margins explode to unimaginable levels. The global economic pie expanded massively. What we are witnessing right now inside companies like Remote is the exact intellectual equivalent of the power loom. For the last 20 years, software development has been a strictly linear factory. If a technology company wanted to ship more features and generate more recurring revenue, they were forced to hire more software engineers. Their payroll expenses grew right alongside their profits, creating a permanent ceiling on their operational margins. Artificial intelligence has permanently destroyed that ceiling. When artificial intelligence is writing 85% of the code, your software engineers are no longer manual laborers typing out syntax. They are transformed into factory managers. They are directing the artificial intelligence, reviewing the architectural output, and orchestrating massive digital systems. This is precisely why Remote was able to boost their revenue per employee by 50%. Notice what they did not do. They did not execute massive headline-grabbing layoffs. When a company announces massive layoffs, it is usually a sign of structural weakness. But the retail herd often cheers for the short-term cost-cutting. Instead of layoffs, Remote practiced disciplined, deferred hiring. To truly grasp how revolutionary this deferred hiring concept is, you must understand the basic mechanics of a traditional corporate balance sheet. In a standard technology company, human capital is always the single largest operational expense. Every time a company hires a new engineer, they are not just paying a base salary. They are paying for expensive healthcare benefits, stock options, office space, specialized equipment, and ongoing training. These fixed costs aggressively eat away at the gross profit margin. When an economic downturn hits, these companies are forced to execute massive, painful layoffs just to survive. Layoffs destroy company morale, they completely stall product innovation, and they signal massive distress to the public markets. But a company utilizing artificial intelligence to achieve deferred hiring completely bypasses this destructive cycle. As their top-line revenue grows, their baseline expenses remain completely flat. Every single new dollar of revenue flows directly to the bottom line as pure, unadulterated profit. This creates a compounding flywheel of capital efficiency. The companies that master this artificial intelligence leverage will eventually acquire their bloated, inefficient competitors for pennies on the dollar during the next economic recession. But this artificial intelligence revolution is not merely a corporate phenomenon. It is fundamentally rewriting the geopolitical chessboard and the rules of global warfare. The technological arms race has escalated far beyond the boardrooms of Silicon Valley. It has reached the highest levels of national security. Recently, a severe data breach exposed a highly sensitive United Kingdom Visa portal. This event was not just a frustrating IT headache for a government agency. It serves as a stark, terrifying reminder that data, privacy, and cybersecurity are now the foundational pillars of national defense. We often say that data is the new oil of the 21st century. But unlike crude oil, when data spills into the wrong hands, the damage is completely invisible, instantaneous, and catastrophic. To truly understand where the massive institutional capital is flowing right now, you have to look at military defense spending. Former CIA Director David Petraeus recently highlighted a profound, terrifying shift in modern warfare. He pointed specifically to the harsh realities of the war in Ukraine. The entire battlefield has been completely transformed by cheap, unmanned aerial systems. Heavily armored vehicles and multi-million-dollar traditional tanks can no longer maneuver or survive anywhere near the front lines. The sky is completely saturated with thousands of cheap, expendable drones. According to military leaders, the current situation is just the primitive beginning. The Pentagon recently dissolved an older, failing drone procurement initiative. In its place, they created the Defense Autonomous Warfare Group, commonly known as DAWG. And the budget request for this new autonomous group is a staggering $4.6 billion. This represents an increase of nearly 4,000% in a single fiscal year. General Petraeus explicitly called this the largest single commitment to autonomous warfare in the history of the world. Why is the United States government suddenly pouring $54 billion into this specific program? Because the next phase of global conflict will be entirely defined by algorithmic drone swarms. These are not drones controlled by a human soldier sitting in a trailer with a joystick. These are tens of thousands of fully autonomous systems, powered by advanced artificial intelligence networks. They will communicate with each other in real time. They will instantly adapt to enemy electronic warfare jamming, and they will execute complex lethal missions with absolutely zero human oversight. Think about the massive historical parallel here. Look at the invention of the heavy machine gun in the years leading up to World War I. European militaries proudly marched into that global conflict using outdated 19th century tactics. They deeply believed in the glory of cavalry charges and tightly concentrated infantry formations. The machine gun made every single one of those traditional tactics instantly obsolete, leading directly to the brutal, bloody stalemate of trench warfare. The armies that stubbornly refused to adapt to the new mechanical reality suffered catastrophic generational losses. Today, artificial intelligence and autonomous algorithmic drone swarms are the modern equivalent of that first machine gun. They render traditional, highly expensive military platforms completely obsolete. The implications of this $54 billion military investment extend far beyond the battlefield. When the United States government commits that level of capital to autonomous systems, it creates a massive guaranteed pipeline of lucrative contracts for the private technology sector. Traditional defense contractors are suddenly forced to rapidly evolve into cutting-edge software companies, while agile Silicon Valley startups are pivoting to secure highly classified government clearance. The lines between national defense and commercial technology are permanently blurring. The hardware required to run these algorithmic drone swarms is incredibly complex. It requires advanced microchips, capable of processing massive amounts of visual data locally, without relying on a vulnerable cloud connection. This pushes the boundaries of edge computing, driving rapid innovation that will eventually trickle down into commercial products. Investors who understand this dynamic are not just buying traditional defense stocks. They are aggressively targeting the semiconductor foundries and the specialized component manufacturers that supply the raw materials for this entirely new era of algorithmic warfare. While the institutional money is quietly and methodically positioning for these massive structural changes, the average retail investor is caught in a vicious cycle of pure emotional panic and fear of missing out. They are desperately chasing the artificial intelligence dream blindly, throwing their hard-earned money at any random ticker symbol. That mentions machine learning on a quarterly earnings call. Financial commentator Jim Cramer recently pointed out a fundamental, destructive flaw in retail investor psychology. Average people obsessively fixate on what a stock price has already done in the past, rather than rigorously analyzing what the underlying business will actually do in the future. We are watching classic textbook herd behavior play out in real time. It looks exactly like a massive flock of birds suddenly changing direction in the open sky. There is no central leader, there is no logical plan, there is just a collective panic and a desperate, sweaty rush to not be left behind by the flock. To further illustrate the sheer danger of unbridled herd mentality, we must look at the legendary warning signs leading up to the catastrophic stock market crash of 1929. In the Roaring '20s, the stock market became a national obsession. The euphoria was completely intoxicating. It is famously said that when legendary investor Joe Kennedy received unsolicited stock tips from his local shoeshine boy. He immediately knew the market had reached a dangerous, unsustainable peak. When the absolute least informed participants in the economy are aggressively speculating on complex financial instruments, the bubble is mathematically ready to burst. The herd fundamentally believes that the rising tide will lift every single boat forever. They borrow money on heavy margin, leveraging their entire financial future on the blind, hope that a greater fool will come along tomorrow, and buy their overvalued shares at an even higher premium. When that greater fool finally stops showing up, the entire highly leveraged system collapses in on itself with terrifying speed. Today, we are seeing the exact same euphoric indicators in the artificial intelligence sector. Retail traders are leveraging their portfolios to buy deeply unprofitable companies. Simply because they mentioned artificial intelligence in a press release, the smart money sees the shoeshine boy offering artificial intelligence stock tips, and they are quietly moving their capital into heavily fortified, defensive infrastructure plays. To truly understand the extreme financial danger of this specific market environment, we have to look back at a fascinating, disastrous period in the late 1960s and early 1970s. This era was known on Wall Street as the Nifty 50 bubble. During this time, institutional investors and retail traders alike became completely obsessed with 50 specific large-cap growth stocks. These beloved companies included massive names like IBM, Polaroid, Xerox, and McDonald's. The prevailing undisputed logic on Wall Street was that these specific companies were so incredibly dominant and so fundamentally superior to everything else that you could safely buy their stock at absolutely any price. Financial advisors proudly called them one-decision stocks, because the only decision you ever had to make in your life was to buy them. You were told to never ever sell them. Basic mathematical valuation simply did not matter anymore. Earnings multiples expanded to completely ridiculous, unjustifiable levels. A company like Polaroid was trading at 90 times its annual earnings. The herd deeply believed that the explosive growth of these companies was mathematically guaranteed to continue forever without any interruption. But cold, hard economic reality always wins in the end. When the vicious bear market of 1973 finally hit, triggered by the global oil crisis and rapidly rising interest rates, the invincible Nifty 50 bubble burst violently. Companies that were supposed to be permanent, safe havens lost 80 to 90% of their total market value. They did not crash because they were bad companies. They crashed because the price that investors paid had completely decoupled from the reality of their future cash flows. We are seeing terrifying echoes of that exact same herd psychology today, with heavily hyped artificial intelligence stocks. The crowd is eagerly jumping into massively stretched names, completely ignoring the incredibly messy reality behind the scenes. They are ignoring the prohibitive high development costs of artificial intelligence models. They are ignoring the massive global shortage of specialized engineering talent. And most importantly, they are completely ignoring the looming, dark threat of harsh regulatory backlash. If the general public suddenly discovers fundamental flaws in how these complex artificial intelligence models handle private consumer data, the resulting mistrust could instantly trigger a severe market correction. But the contrarian investors, the true smart money, they are not playing that dangerous game of musical chairs. They are meticulously looking for companies, making real, boring operational shifts. When a giant like Amazon brings in a specialized healthcare technology founder to run its internal health division, that is a calculated long-term play for sustainable value. In a highly regulated sector, the smart money is aggressively looking for the foundational picks and shovels. They are buying the massive data centers, the industrial energy providers, and the elite security firms. They are quietly finding immense alpha, exactly where the loud crowd is not looking. So how do you actually survive and generate generational wealth in a tech market that is violently seesawing between absolute, unbridled greed and hidden, lurking fear? You have to strictly follow the Titan's playbook. The current financial landscape requires a highly disciplined, nuanced approach to asset allocation. We strongly recommend a strict 70-20-10 model for your portfolio. That means 70% heavily allocated to strategic growth equities, 20% locked into safe defensive assets, and 10% held purely in liquid cash. This is absolutely not the time to buy the entire stock market, blindly through a broad index and simply hope for the best. You need surgical, targeted exposure. For the heavy equity portion of your portfolio, you must focus relentlessly on the physical infrastructure that makes this entire digital revolution possible. Advanced semiconductors are the undisputed picks and shovels of the artificial intelligence gold rush. Exchange-traded funds like SMH specifically capture the exact companies that are manufacturing the physical brains of this entire new era. Cloud computing innovators, tracked by funds like SKYY and CLOU, are absolutely essential because artificial intelligence has an insatiable, bottomless appetite for massive data, storage, and raw processing power. And crucially, you must hold dedicated cybersecurity funds like CIBR or BUG. As the digital attack surface expands exponentially, with the rise of autonomous systems and global remote workforces, cybersecurity transforms into the ultimate defensive growth sector. But simply knowing what assets to buy is only half the battle. The actual mechanical execution of how you buy them is what ultimately separates the wealthy winners from the broken victims. In a market this wildly unpredictable, dollar-cost averaging is your absolute, most powerful financial weapon. To truly understand why this is so critical, look at average investor behavior during the devastating 2008 global financial crisis, when the housing market violently collapsed and the stock market lost half of its total value. Flawed. Human psychology caused massive, irreversible financial destruction. The amygdala, which is the primitive part of the human brain, strictly responsible for fear and survival, completely overrode the prefrontal cortex, which handles logical planning and mathematics. Millions of terrified investors panicked and aggressively sold their entire portfolios at the absolute bottom of the market, permanently locking in devastating losses. They swore to themselves that they would get back into the market later, when things finally felt safe again. But by the time the economic news headlines turned positive and comforting in 2012, the stock market had already staged a massive, historic multi-year rally, and those fearful investors missed out entirely on the recovery. Dollar-cost averaging completely removes the deeply flawed human brain from the investment equation. By strictly investing a fixed dollar amount at regular scheduled intervals, regardless of what the terrifying news headlines say, you mechanically force yourself to buy more shares when prices are bleeding and fewer shares when prices are euphoric. It is a completely automated risk management system that actively feeds on market volatility. Our VIP action plan has two crystal-clear directives, based entirely on this emotional discipline. First, if any major technology company faces a massive data breach or a highly publicized artificial intelligence privacy scandal, immediately initiate a 15% position in a cybersecurity ETF. That sudden public panic will instantly trigger an institutional rush to buy digital defense assets. Second, you must gradually increase your exposure to semiconductor ETFs by 5% increments anytime. The sector experiences a brutal 10% pullback from its recent highs. Do not ever chase the green days. Buy the red days systematically and ruthlessly. The global technology landscape still heavily favors United States exposure because American corporate giants completely lead the foundational research and the massive capital-intensive cloud deployments required for this entire shift. History consistently and loudly reminds us that massive technological revolutions are always chaotic and messy. From the explosive railroad boom of the 1800s to the rapid mobile computing shift of the 2010s, the historical pattern is perfectly identical every single time. Initial wild exuberance leads to a painful, crushing consolidation, which is then followed by a clear, final separation of enduring value from speculative froth. The artificial intelligence transformation will be absolutely no different. True, generational wealth is not created by chasing ephemeral, loud hype. It is strictly created by disciplined execution, proactive risk management, and the cold patience to hold robust business models through the inevitable violent storms.